Welcome, scholars, to Chapter 2. In this chapter, we will be discussing the role of financial markets and financial intermediaries. In Hamlet, advice is given to neither a borrower nor a lender be. Participants in financial markets and financial intermediaries violate both parts of that advice. Financial intermediaries borrow from one group and lend to another, a process that channels resources into productive investments. The transfer of savings through financial intermediaries from individuals with funds to firms, governments, and other individuals who need funds is one crucial component of the financial system. Financial markets perform two extremely important functions. Financial markets facilitate the transfer of funds from savers to firms, governments, and individuals who use the funds. Financial markets, however, also facilitate the transfer of existing securities from sellers to buyers. Our learning objectives for Chapter 2 are, by the end of this chapter, you should be able to define money and determine how the money supply is measured. Develop a yield curve and contrast positive and negative yield curves. Differentiate the direct and indirect transfer of savings to the users of funds. Enumerate the primary assets and liabilities of a commercial bank. Describe several regulations that apply to the banking system. Differentiate required and excess bank reserves. Explain the role of FDIC. Compare the assets of life insurance companies and commercial banks, and contrast the various money market instruments. The role of money. Money can be defined as anything that is generally accepted as payment for goods and services or for the retirement of debt. Anything may perform the role of money. Throughout history, many different items, including shells, stones, metals, have all served as money. In our country, in the United States of America, a variety of coins and paper monies have served as forms of money and payment. In recent years, there are advocates of digital cryptocurrencies that have suggested that Bitcoin be considered as money. And in 2022, the U.S. Central Bank released a paper contemplating the possible creation of a central bank digital currency or digital dollar. And so money can be anything, or anything can perform the role of money. But money, it also has to be generally accepted. In other words, whatever you're using for money has to be generally accepted as money. Money can also be used as to transfer purchasing power to the future. In this role, money acts as a store of value from one time period to another. Money is only one of many assets that may be used to store value. So, for example, stocks, bonds, savings accounts, savings bonds, real estate, gold, silver, collectibles, all of these are various assets that you may use as store value. Liquidity then becomes into play with that, because liquidity is the ease of converting an asset into cash without loss. Measures of supply of money. The total amount of money in circulation is known as money supply. The traditional measure of money supply is referred to as M1. It is the sum of coins and currency in circulation outside of banks, demand deposits including interest-bearing checking accounts held by the general public in all depository institutions, and savings accounts and other checkable deposits held by the general public in all depository institutions. Now there is a broader definition of the supply of money, and that's referred to as M2, and that includes everything in M1 plus the retail money market funds and small certificates of deposit that are less than $100,000. Then we shift our focus to the role of interest rates. The words money and interest are often used together, but their meanings differ and they perform different roles. Money is a medium of exchange. Its value is related to what it can purchase. Interest is the price of money. It's the amount that one pays to use another's money for a period of time, for example, 1 year. So interest is the amount that one pays to use another's money for a period of time. For example, you want to purchase a car. You don't have $20,000 to purchase that car. So you go to the bank. You're using the bank's money to purchase that car. And so what happens is the bank is going to charge you interest to use their money. And so when you pay that back, instead of just paying back the bank $20,000, you may end up paying back the bank $28,000, $29,000, $30,000, depending on the interest rate that is specified for that period of time. So you may borrow $20,000 today to purchase a car, and you agree to pay back that $20,000 to the bank over a period of 5 years at a specific interest rate. And when you have paid all of that back, you've paid back the $20,000 plus the interest. And so the bank actually makes money. So instead of getting $20,000 back, they may get $30,000 back. Interest helps allocate scarce credit among competing uses for the funds. Interest rates can be set for short term, which is a year or less, intermediate term 1 to 10 years, and then long term over 10 years. The term structure of interest rates. The relationship between yields and the time to maturity for debt with a given level of risk. So the book talks about a yield curve. That's a graph that relates the yield on debt instruments with different terms to maturity. And so we have an example here of yield curves. Most typically, yield curves are positively sloped, as you can see in figure 2.1. It indicates that the longer the borrower has the use of the funds, the greater is the cost of the funds. So for example, if you take a year and only pay back, it's going to cost you less. The lender will make less, but the longer you have that loan, the longer that you borrow that money, it has a greater cost to you, and then it also helps the lender make more money. There have been periods when the yield curve was negative and short-term rates exceeded long-term rates, which is very rare, but it did happen in September of 81 and then also April of 89. Financial markets and the transfer of savings. Financial markets transfer savings to productive uses using two different methods. First is direct investment. When you start your own business and invest your savings, or when new securities are issued in the primary market. The second way, or the second method that financial markets transfer savings to productive uses is indirectly through financial intermediaries. Financial markets also transfer existing securities in the secondary market. So, the authors write in the text, after working and earning income, my Auntie B's advice was to spend a little, give a little, and save a little. Each year I would take that advice. After I decide how much to save instead of spending, I have to make an additional decision. What to do with my savings? Should I put the funds in a bank, buy stock, or shares in a mutual fund? I'm not going to let the funds sit idle. I want to put them to productive use to earn a return. Now, this process is not limited to individuals. Firms also have savings. Earnings that are not distributed are retained and saved. Management must decide what to do with those savings. Perhaps they will make some investments in plants or equipment or other productive assets. They can also invest those funds in financial assets for short periods of time prior to the acquisition of assets such as plants and equipment. The financial managers of governments go through the same thought process. The government collects tax revenues but does not necessarily spend the funds immediately. The funds may be placed in a short-term investment to earn a return. The same principles apply to nonprofit organizations such as charitable foundations. In each instance, the current savings are invested to earn a return. So the indirect transfer through financial intermediaries. Funds are transferred from savers to borrowers through financial intermediaries. These include commercial banks, thrift institutions such as savings and loan associations, mutual savings banks, credit unions, also life insurance companies, pension plans, and money market mutual funds. So I'm going to ask a question. I'm going to give you just a few minutes to think about it. What is the difference between direct and indirect transfer funds? What is the difference between direct and indirect transfer of funds? With direct transfers, borrowers acquire funds directly from lenders by selling them securities. For example, if a company is selling stock and they go public and individuals in the public buy that stock, that is a direct transfer. Indirect transfers are funds that are transferred from savers to borrowers through financial intermediaries. In other words, I take my money to the bank, I put my money in the bank then takes that money and turns around and lends it out to other people. And so that is an intermediary. And then I'm still expecting my money, but when it comes time to get my money, I'm not going to the other individual, I'm going directly to the bank, and the bank gives me my money. Monetary Control Act of 1980. This is where depository institutions became regulated by the Federal Reserve. it granted the right to borrow funds from the Federal Reserve, and the net effect of the reforms, it reduced differentiation among intermediaries, and it increased competition among intermediaries. If you look at Exhibit 2.1, it shows the assets and liabilities of commercial banks as of January 2022, and that's all in billions of dollars. So the assets, you've got cash, which includes currency, coins, cash items and processed deposits with the Federal Reserve, U.S. government securities, and I want you to notice that 17% of the assets of commercial banks was made up with cash. 20% is the U.S. government securities, then other securities. Loans, commercial and industrial loans make up 11%. Real estate is 21%. And then loans to individuals constitute 7.3%. And then interbank and other loans. And then other assets for a total. And then the liabilities, I want you to notice the liabilities of a commercial bank. 73% of a bank's liabilities are demand deposits, savings accounts, and CDs. So the demand deposit there is referencing a checking account. The primary liabilities of commercial banks are their deposits, checking accounts, various types of savings, and time deposits. And then there's also CDs. Funds that are deposited in a regular savings account can be withdrawn at will. However, time deposits, which are known as certificates of deposits, they are issued for a fixed term such as 6 months or 2 years. And so the saver generally cannot redeem the CD prior to the maturity date without paying a penalty. For CDs issued in denominations of $100,000 or larger, the rate of the interest and length of time to maturity are mutually agreed upon by the bank and the saver with funds, and these are referred to as jumbo CDs. And so we see again the primary assets are loans to firms and consumer loans, and then most loans at commercial banks are short term, which gives a rapid turnover of bank deposits, especially demand deposits. And so there's a need for banks to adapt their portfolios to changes in economic environment and level of interest rates. The primary liabilities of commercial banks are the deposits, checking accounts, and then also savings and time deposits that we were just talking about with CDs. Now, again, I want to go back and discuss time deposits. These are referred to as CDs. It is a time deposit issued by a bank with a specified interest rate and maturity. So you may go get a 9-month CD, and you put $1,000 down, $1,000 into that CD. In 9 months, you can cash it out, and you've earned interest on that $1,000. And CDs can come in various types and amounts. CDs that are larger than $100,000 or more, these are jumbo CDs. The terms are negotiated between the bank and the saver. And there's also a secondary market for large denomination CDs. And so large denomination CDs may be bought and sold, and they are differentiated from smaller CDs which cannot be sold but may be redeemed prior to maturity, but usually with a penalty. Thrift institutions. These are, as the name implies, thrift institutions are a place for savers, especially individuals with modest sums, to deposit funds. The money is then loaned by the thrift to borrowers in need of the funds. There are essentially two types of thrifts: mutual savings banks and S&Ls, or savings and loans. So mutual savings banks are owned by depositors. They are managed by a board of trustees, and they must have sufficient liquidity to meet withdrawals. Mutual savings banks were developed in the early 1800s to encourage savings. Some had colorful names. Um, S&Ls developed later, and they are primarily as a source of mortgage loans. So they accept deposits and then they make a variety of loans. Emphasis is on mortgage loans. Now, savings and loans institutions typically pay a higher rate of interest than commercial banks. The reason is where they specialize in mortgage loans, and mortgage loans have longer terms than commercial loans, and longer term loans typically have higher interest rates. Then the S&Ls can turn around and give higher interest rates because of the types of loans they are lending out, and they still are able to make money that way. So then we turn our attention to the regulation of commercial banks and thrift institutions. Required reserves are funds that banks hold against deposit liabilities. And so the regulation of banks comes from both state and federal banking authorities and the Federal Deposit Insurance Corporation, FDIC. So required reserves is the minimum amount that all banks must maintain as a reserve as determined by the Federal Reserve. While holding reserves against deposit liabilities may increase the safety of the deposits, such safety is not the prime reason for having reserve requirements. This will be explained later in Chapter 5. The reserve requirement is one of the tools of monetary control. This element of control, not safety, is the reason for having a reserve requirement against deposit liabilities of bank. So, for example, prior to March 26, 2020, checking accounts had a reserve requirement of 10%. The first $127.5 million in checking accounts have a reserve requirement of 3%. Time deposits had no reserve requirements. On March 26, 2020, to make monetary policy more accommodative as financial markets and the economy were under strain due to COVID-19, the Federal Reserve reduced these reserve requirements to zero. This action reduced required reserves by approximately $200 billion. So banks can hold reserves in two forms. They can either hold it as cash in the vault or deposits with another bank, especially the Federal Reserve. If the bank's reserve requirement is 10% for demand deposits and the bank receives $100 in cash in a checking account, it must hold $10 in reserve against the new demand deposit. The entire $100 in cash is considered part of the bank's total reserves, but the bank must hold only $10 against the deposit liability. The bank may choose to hold $1 of the required reserves in cash in the vault to meet cash withdrawals, and then $9 in the Federal Reserve. The remaining $90 are funds that the bank does not have to hold in reserve. This is excess reserves. That's the difference between the bank's total reserves and its required reserves. So a commercial bank's excess reserves may be lent to borrowers or used for some other purposes, such as purchasing government securities. If a commercial bank does not have any excess reserves, it is said to be fully loaned up. Commercial banks may deposit their reserves in the Federal Reserve Bank or in other banks called correspondent banks. Correspondent banks in many cases are large metropolitan commercial banks, and they are important to the well-being of small local banks. Secondary reserves are high-quality, short-term marketable securities such as U.S. government securities, treasury bills that may be readily sold. The short-term marketable securities offer a bank both a source of interest income and a means to obtain funds quickly to cover a shortage in its reserves. The importance of reserves and reserve requirements cannot be exaggerated. It is very important for commercial banks to have reserves and reserve requirements. Deposit insurance. Federal deposit insurance is one of the positive results of the Great Depression of the 1930s. It came about because large losses sustained by commercial banks depositors led to the establishment of the FDIC. All commercial banks that are members of the Federal Reserve System must purchase insurance from the FDIC. FDIC insures deposits up to $250,000. So if you have $250,000 in a bank and that bank fails and it is a part of the Federal Reserve System, it has FDIC insurance, then even if that bank fails, your $250,000 is safe. Now, the FDIC, along with other regulatory agencies, examine banks. However, the establishment of the FDIC and other regulatory agencies has not eliminated bank failures. In fact, failures became common occurrence as the result of the financial crisis that started in 2008. If you look at the chart, you can see that during 2007, only 3 banks failed. Then the number of bank failures increased to 25 in 2008 and jumped to 140 failures in 2009, and then also in 2010, 157 failed. Now, when you look at the assets that was lost because of that, we see the importance of why banks need to be regulated and examined, because a lot of people lost a lot of money because of those. Now, sometimes if a bank does fail, the FDIC will generally seek to merge that bank into a stronger bank. The transfer of deposits saves FDIC from having to reimburse depositors. For example, when Washington Mutual failed, its assets were acquired by J.P. Morgan Chase. Its depositors and customers became depositors and customers of the acquiring bank. There was no interruption of banking services. Depositors did not sustain any losses. However, if a merger cannot be arranged, the bank may be liquidated, in which case the depositors receive reimbursement up to the legal limit. Life insurance companies. So again, we're talking about intermediaries. The second type of intermediary is life insurance companies. Life insurance companies also perform the role of financial intermediary because they receive the funds of savers, create a claim on themselves, and lend the funds to borrowers. So other types of insurance, such as property and liability insurance, are exclusively services that the individual buys. So there is a distinction between them and life insurance companies. Now, the feature that differentiates life insurance from other forms of insurance and makes life insurance companies financial intermediaries is that life insurance may provide more than insurance against premature death. So there are ordinary and universal life insurance policies, and endowments contain two elements: the insurance and then the savings plan. The policy's premiums cover both the cost of the insurance and the savings program. As long as the policy is enforced, the policy accumulates cash value, which is the savings component of the policy. Many savers find that such policies attractive because the periodic payments ensure them of insurance plus a savings program. Others find them unattractive because the interest paid on the savings may be less than that can be earned in alternative investments. Life insurance companies use proceeds from policies to acquire income-earning assets. Since long-term investments tend to earn higher interest rates than short-term debt, a life insurance company will seek to have a substantial amount of its funds in these more profitable investments. Pension plans. The role of a pension plan is to accumulate assets for workers so that they will have funds for retirement. Funds are periodically put in the pension plan by the saver, the employer, or both. So there are, pension plans and the retirement accounts, those sorts of things. Sometimes the company that you work for will match your donation of what you are putting into that account. And so you and the employer both may be adding to those funds. And for a pension plan to serve as a financial intermediary, it must pass the funds directly to a borrower or invest them directly in a firm. For example, CREF, C-R-E-F, primarily purchases existing corporate stock. CREF is the College Retirement Equity Fund. So what it does is it takes the money that is deposited into it, and then it goes and purchases existing corporate stock to help earn interest on that pension plan. Many pension plans do not invest or lend the money directly to borrowers. For example, the TIAA, and that is the Teachers Insurance and Annuity Association. TIAA stresses debt, especially mortgages. So the TIAA, in this case, funds are transferred from savers to borrowers, and the pension plan is acting as a financial intermediary. creates a claim on itself when it receives the saver's funds, and it receives a claim from borrowers when the funds are lent to finance purchases. And in both of these cases, you are taking the money that is put into that pension and trying to earn more money with that. Money market mutual funds. One of the most important financial institutions is the mutual fund that invests on behalf of individuals. It's an investment company that invests solely in short-term money market instruments. Money market mutual funds compete directly with banks. They offer the advantages of somewhat higher yields and are almost comparable in safety with banks. So the reason that people will invest in money market mutual funds is that typically they offer higher yields of return, and they're almost as safe as depositing into a bank. Shares are not federally insured like deposits in banks, but the reason that they are considered safer is that short-term nature of their portfolios affords the saver safety of principal. Money market instruments include U.S. Treasury bill, commercial paper, repurchase agreement or repo, bankers' acceptances, and tax anticipation notes. The safest short-term security is the U.S. Treasury bill. It is commonly referred to as the T-bill. It is issued by the federal government. Commercial paper is an unsecured short-term note issued by a corporation as an alternative to borrowing funds from commercial banks. Since the paper is usually unsecured, only firms that has a excellent credit rating can sell it. Hence, the risk of default is small and the repayment of principal is virtually assured. A repo or a repurchase agreement is a sale of a security in which the borrower, agrees to buy back or repurchase the security at a specified price at a specified date. Bankers' acceptances are short-term promissory notes that are guaranteed by a bank. Tax anticipation notes are issued by states or municipalities to finance current operations before tax revenues are received. As the taxes are collected, the proceeds are used to retire the debt. With these anticipation notes, while these anticipation notes do not offer the safety of treasury bills, the upside is the interest is exempt from federal income taxation. So the interest paid on debt issued by state and local governments is exempt from federal income taxation. And these types of securities are discussed in more detail later on in Chapter 12 when we're discussing about bonds. A commercial bank or any financial intermediary can lend only what has been lent to it. Therefore, financial intermediaries compete with each other for funds. If funds flow out of financial intermediaries, they make fewer loans, and it increases the cost of credit. A transfer of funds from one intermediary to another can affect the supply of credit available to a particular sector of the economy. One of the things that we must keep in mind is that specialization is disappearing. And what I mean by that is Historically, financial intermediaries have been categorized on the basis of the services or products offered. However, today that's only partially true. In the past, savers bought life insurance through insurance agents, bought stocks through security brokers, and invested funds in a savings account in a bank. Those days are disappearing. Insurance agents, stockbrokers, and bankers today offer a wide spectrum of services and financial products. For example, many commercial banks offer savers not only the traditional services of savings and checking accounts, but also offer products such as brokerage services to compete with stockbrokers, money market accounts to compete with money market mutual funds, and pension plans to compete with insurance companies and mutual funds. S&Ls offer savings and checkings accounts, life insurance, and brokerage services also. And so each of these have started to expand their services because of competition. We're going to end with a little discussion activity, and I'm going to ask you a question. I want you to think about it, and then we're going to discuss it in a conclusion. How is technology changing the financial markets? Technology is changing the way money is raised. For example, crowdfunding. Technology is also changing the way payments are made. For example, PayPal. One of the things that I have seen change in my time is growing up, my grandparents used cash and checks for everything. They carried cash. When they made payments, they would go to the place where they were going to make their payment, and they would write a check or give them cash. Today, with PayPal, debit cards, credit cards, other types, Apple Pay, all of these, and now online banking, online payment, things have changed, and now you no longer have to go to the water company to pay your water bill. You can pay your water bill online. You no longer have to go to your TV service provider and make your payment there. You can pay it online. And it's you don't have to write a check. You don't have to give cash. You can use your debit card or credit card. And so technology has changed the way payments have made. Technology is also changing the definition of money. For example, crypto, Bitcoin. And so these things are coming to fruition. I hope that you have enjoyed our discussion on Chapter 2. And this will be the last PowerPoint for this week. Make sure that you are checking Canvas and completing all of your assignments, that you get your discussion board done, and get chapters 1 and 2 read from your textbook.